Devon Energy and Coterra. Energy announced a $58 billion all-stock merger on February 2, 2026, creating one of the largest shale producers in the United States. The combined company's pro forma production for the third quarter of 2025 is expected to exceed 1.6 million barrels of oil equivalent per day. So the question is, how will this merger reshape the U.S. shale landscape? And what does this mean for energy consolidation amid rising oil demands? Let's solve this equation. Welcome back, strategists. This is the Resource Equation, your briefing room where data, capital, and strategy collide. New here? Subscribe for weekly breakdowns of what's really moving markets. On February 2nd, Devon Energy and Coterra Energy publicly disclosed a definitive agreement to merge in an all-stock transaction valued at approximately $58 billion. The deal combines two major U.S. shale producers, creating a company that will operate under the Devon Energy name and be headquartered in Houston, while maintaining a significant operational presence in Oklahoma City. The merger is structured so that Coterra shareholders will receive 0.70 shares of Devon common stock for each Coterra share, resulting in Devon shareholders owning about 54% of the new entity and Coterra shareholders holding roughly 46%. Both companies' boards unanimously approved the deal, which is expected to close in the second quarter of 2026, pending regulatory and shareholder approvals. Here's where it gets interesting. The combined company will have a pro forma production exceeding 1.6 million barrels of oil equivalent per day by the third quarter of 2025. This includes more than 550,000 barrels of oil per day and 4.3 billion cubic feet of natural gas per day. Its operations will span key U.S. shale basins, including the Permian Basin, Marcellus Shale, Anadarko Basin, Eagle Ford, and the Rockies. Notably, the merger significantly strengthens Devon's position in the Delaware Basin, consolidating nearly 750,000 net acres in this core area, with a break-even cost below $40 per barrel. Why does this matter? Surface level. The merger creates one of the largest shale producers with a diversified asset base and scale advantages. But dig deeper, and the deal reflects broader industry trends emphasizing inventory depth, capital efficiency, and balance sheet strength over rapid growth. The combined company expects to generate $1 billion in annual pre-tax synergies by the end of 2027. These savings will come from capital optimization, operational efficiencies, and reduced corporate costs, factors that directly impact free cash flow in a capital-disciplined shale environment. Okay, stop. Rewind for a second. Three numbers tell the story. First, $58 billion, the implied enterprise value of the merger. Second, 1.6 million barrels of oil equivalent per day, the expected production scale. And here's the kicker, $1 billion in annual pre-tax synergies, showcasing the financial efficiencies targeted by this consolidation. The merger also signals how producers are navigating a challenging price environment. With oil prices hovering around 60 per barrel or lower, expanding drilling programs can strain margins. By combining operations, Devon and Coterra aim to optimize capital allocation and improve operational efficiency, which may help sustain returns despite market pressures. The combined company plans to maintain an investment-grade balance sheet, with pro forma net debt to EBITDAX around 0.9 times and liquidity of $4.4 billion, underscoring financial discipline. Pause here. Does this make sense? Drop your take in the comments. Market reactions to the merger announcement have yet to be fully detailed in the research available. However, the deal ranks among the largest upstream combinations in recent years, following the $26 billion acquisition of Endeavor Energy Resources by Diamondback in 2024. This consolidation wave reflects growing industry focus on scale and operational efficiency amid fluctuating commodity prices and rising costs. Contextually, the shale sector has seen increasing consolidation as companies seek to balance growth with capital discipline. The Devon Coterra merger fits this pattern by combining complementary assets and operational footprints. The combined company will have one of the largest drilling inventories in the Delaware Basin, with more than 10 years of high-quality drilling opportunities at break-even costs below $40 per barrel. This inventory depth is a critical factor for long-term production sustainability and cost control. But wait, there's a twist. The transaction is not only about scale, but also shareholder returns. Upon closing, the company plans to pay a quarterly dividend of $0.315 per share and authorize over $5 billion in share repurchases. This approach highlights a strategic emphasis on returning capital to shareholders alongside operational growth. Remember that question about how this merger will reshape the shale industry? We're getting closer to understanding its implications for consolidation trends and financial strategies. Real talk. What's your hypothesis on why Devon Coterra chose an all-stock transaction instead of a cash deal? Share your thoughts below. Back to our opening question. Here's what we now know. The merger creates a U.S. shale giant with diversified production across 5 major basins and a production scale exceeding 1.6 million barrels of oil equivalent per day. The deal underscores a strategic shift toward operational efficiency, capital discipline, and shareholder returns in a market facing price volatility and cost pressures. However, the full impact on market dynamics and energy supply will depend on execution and regulatory approvals, which remain pending. Looking ahead, the transaction is expected to close in the second quarter of 2026. Stakeholders will be watching for regulatory decisions, shareholder votes, and the combined company's integration progress. These milestones will provide further clarity on how the merged entity will perform operationally and financially. How do you interpret this merger? Who do you think will be most affected by this consolidation? Producers, investors, or the broader energy market? What signals are you watching for in the coming months? Let me know in the comments. And if you found this valuable, hit that like button. Quick reminder. This video reports and explains public information. It does not offer investment advice. Now, while the Devon Coterra merger is grabbing headlines, there's another equation being solved in real time. Rio Tinto and Glencore's $260 billion merger. If you think today's story matters, you need to see what we uncovered there. Link in the description. Watch it next. Subscribe to the Resource Equation for weekly breakdowns like this. Next up, how shifting global supply chains are influencing commodity markets. See you in the next one.